Now, the second cost of inflation is that inflation redistributes wealth. Wealth doesn't depend upon how many dollars we have. How many dollars we have is a nominal issue. Wealth depends upon what we can buy with those dollars. What is our real purchasing power? The real rate of return for a lender is defined as follows. The actual rate of return is equal to the nominal interest rate, which is the rate we see quoted on any sort of loan that we have, less the inflation rate. So to understand the difference between the nominal interest rate, which is telling you the rate at which your dollars are increasing, and the actual rate of return or the real return, we need to correct for inflation. So consider the following example, which will show us how inflation redistributes wealth. Suppose a bank makes a 30-year loan at an interest rate of 7%. If the inflation rate during this time period is 3%, then the bank's actual return is going to only be 4%. The nominal return in terms of the number of dollars that the bank will get from the borrower is going to be 7%. But when you look at the purchasing power of those dollars, when you correct for inflation, the bank's real purchasing power will only increase by 4%. However, if inflation rises unexpectedly to 13%, as it did in the late 1970s, then the bank's actual rate of return here would be 6%. Again, it's that nominal return, which is set on that 30-year mortgage, less the actual inflation rate, which we never expected at 13%, gives me the real return. So the bank did not expect this high inflation rate, otherwise they would have charged a higher nominal return. Since this inflation was unexpected, the bank's real purchasing power is negative. This is an example how the lender is losing money off the loan and the borrower gains. Why? Because in terms of what the borrower needs to pay back, in real terms they pay back less than what they actually borrowed. So what happens if people expect inflation to go up? If inflation is expected to go up, then lenders will increase the nominal rate of interest. So let's revisit something that we talked about in an earlier chapter. This real rate of return given here, this real equilibrium rate of return, is the return that is set in the loanable funds market. So that's where the demand for loanable funds is equal to the supply of loanable funds. The banks would like to get at least that real return. And so let's say that's 3%. Hence, if the bank expects, let's say, 2% inflation over the course of a loan, then they will charge a nominal interest rate equal to the expected inflation rate plus the real return that is being set in the loanable funds market. So set a nominal interest rate of 5%. This is what's known as the Fisher effect. That is, this tendency for nominal interest rates to rise with expected inflation. Consider the evidence supporting the Fisher effect. In this graph, the blue series represents the actual inflation rate. The red represents the nominal interest rate. So whenever the nominal interest rate lies above the inflation rate, the bank is earning a real rate of return. However, in a period like you see here in the mid-70s, inflation was higher than what firms expected. As a result, the real rate of return was negative. Reason it's negative? Because the inflation rate exceeds the nominal interest rate. The bank set a nominal interest rate based on what they thought inflation would be, but because of unexpected inflation, the real rate was actually negative. Now, from earlier equations, we have the following. The actual rate of return is equal to the interest rate less the inflation rate. And based on the Fisher effect, banks will set those nominal rates by adding together the equilibrium interest rate, which is set in the market for loanable funds, plus any expected inflation rate. If you substitute I from this equation into equation number 1 and do a little rewriting, we get the following expression. Now, let's take a closer look at what this expression means. This expression right here, let's focus on this term here, says that, look, if the expected inflation rate is less than the actual inflation rate, this term will be negative, which means that the actual return or the real rate will be less than the equilibrium rate. In that case, the borrowers are the ones who are going to benefit from this unexpected inflation, and it's going to be the lenders who are harmed. They're going to get a rate that was lower than what they had wanted. If, however, the expected inflation rate is greater than the actual inflation rate observed, this term is positive, and the actual or the real rate of return is going to be greater than what we had expected. So in this case, the real rate is greater than the equilibrium rate, and that's going to benefit the lenders. They get a higher real return than what they expected, and that's going to harm the borrowers. So here you see that wealth will be redistributed whenever the expected inflation rate differs from the actual inflation rate. And in this last scenario, just talks about what if they're equal. If the expected inflation rate and the actual inflation rate are equal, then there's absolutely no redistribution of wealth. Now, workers and firms are also affected by inflation. Wage agreements are often made several years in advance, and if we underestimate inflation, wages are going to be too low. And so in real terms, the supply of labor too is going to be too low. If we overestimate inflation, then we're going to set wages too high, which means that firms will not want to hire as many people, and so the demand for labor is going to be too low. Conclusion, if you make errors in estimating the rate of inflation, you're going to have a misallocation of resources, which is going to affect your economic growth. So if we don't estimate inflation perfectly, we may fall into a trap where if we've underestimated it, you're not going to get enough workers who are willing to work in the industry. And if you overestimate inflation, then firms are not going to be willing to hire as many workers. Now, hyperinflation can break down financial intermediation. If inflation is moderate and stable, then lenders and borrowers are able to forecast inflation rates fairly well. Loans can be signed with rough certainty regarding the value of future payments. Again, remember we talked about earlier that the amount of the real return that I earn depends upon what the expected inflation rate is. Well, if I have a pretty good idea about what the expected inflation rate is, then I will set my nominal return at a rate that will give me a desirable real return. But if inflation is high and volatile, long-term risk becomes high. I become really uncertain about what the inflation rate is going to be, and so loans may not be signed at all. I don't want to risk getting burned. I don't want to risk underestimating the actual rate of inflation. In this case, financial intermediation breaks down. Borrowers and lenders do not want to sign loan agreements. And so financial intermediation breaks down. That can create problems in the economy because you're not going to have as much capital accumulation and you're going to have less economic growth. Consider Peru. Between 1987 and 1992, Peru was experiencing hyperinflation. During this time, private loans virtually disappeared. Again, very erratic inflation rates. Nobody wanted to lend money when there was so much uncertainty in the economy. So without any loans, investment fell and the economy collapsed. Another example is Mexico. In the 1980s, Mexico had inflation rates that exceeded 100%. Long-term loans were hard to get. As recently as 2002, even 90% of debt matured within 1 year. People were not able to get a 30-year mortgage. There was just too much uncertainty about what inflation rates would be more than 1 year out, and so it was hard to get those sorts of loans. Most of the loans that were written such that you had to repay the borrower within a year. So as you can imagine, if that's the case, people are not going to borrow a whole lot of money. Since the 1990s, however, inflation within Mexico has been tamed. The result, you have rapidly growing capital markets and increased investment. When Mexico was able to manage its inflation rates, more loans were signed, there was more activity in the capital markets, and that increased investment and economic growth.